Hello, welcome to Season 2, Episode 2 of the Traders Workshop Podcast. I'm your host, Adam Grimes. You can find more of my work at my blog, adamhgrimes.com, and you also should be following me on Twitter at AdamHGrimes. So I have an old podcast called the MarketLife Podcast, and there were many episodes there that when we took that podcast down to launch Traders Workshop, people kept asking about those old episodes. And I think it's interesting to look back on some of those things and to see that these are really, all of these ideas we talk about are evergreen, enduring, almost universal principles. So I want to reissue one of these old podcasts today. And this episode came from the middle of 2015. The topic was managing trades, making trades in market extremes. Well, that was 2015. This is now early 2020, March 2020, and the market has moved into historic extremes. We're seeing the stock market move literally in an hour what it would normally move in the space of a year, and many, many days where we have even average daily swings are larger than a month would have been, just as the volatility's moved up to a new regime. This is all in response to the coronavirus situation. We're also seeing ridiculous levels of volatility in currencies, in commodities. Crude oil is well under $25 a barrel as I'm recording this. It would have been unthinkable just a few weeks ago. So this is certainly a period of market extremes, extreme volatility. And I think in this environment, it's very interesting to revisit what I said a few years ago. So without any further ado, here's that podcast.
Today about trading acts of God. This is a particularly timely topic. Here at the beginning of July 2015, the markets have seen a large impact from the situation in Greece, concerns over the future, what might happen there. And this brings, we can generalize the lessons here and the ideas to how to handle these large, unpredictable movements. So that term acts of God, that can be a little bit polarizing. If you're not a native English speaker, similar phrases exist in most languages, but it's a legal term or perhaps a semi-legal term that basically means uncontrollable, things that happen due to uncontrollable and unforeseeable natural events. So typical acts of God would be things like hurricanes, earthquakes, tornadoes, weather-driven. In markets, we can certainly generalize that to political events, to, for instance, an assassination, and to, it's not much of a leap to say that what has happened in Greece recently is essentially an act of God, even though, in retrospect, and that's one thing we'll talk about, it's always easy to look back and see the causative chains, the causative connections in the chain. It's not so easy to do going forward, and that's really where our focus needs to be. So these things, these events, disrupt markets. And they can be very large impacts. They can be small impacts. They can be temporary or long-lasting. And really, that's the question. I think there's this part of the, I don't even know what the word is. Let's say newsletter writers. I don't even want to say investment advisory because it's not truly that. But there's this group of newsletter writers who are very popular. And I've spoken about this before. What they do is they capitalize on fears. They want you to believe that sometime in the future, the entire financial system, the entire world, the entire society that is going to break down. And read their writing. So first of all, we can commiserate over this and pay them money. And secondly, protect yourself by doing odd things like buying gold. It doesn't really make sense. But there's always this idea that there is some event around the corner. And that there's some event that's going to change things. And, this is, if I can wax a little bit philosophical here, and I can because it's my podcast and you are strapped in and along for the ride. I think this kind of plays into a bigger thing that I don't quite understand that is prevalent in just human thought in general. In the religions talk about eschatology, and this is the writing and thinking about the end of the world, the end times. Most religions have things that deal with these eschatological concepts. But what I think people don't realize so much is there's also this strong thread of secular eschatology, this coming end of the world. Think about that. I found myself in a conversation saying that phrase, secular eschatology, and that's something that I had never really thought about. But there are these fringe groups that are actually not so fringe that forecast like some coming singularity, that events are happening faster and faster. One of the things that I used to hear a lot about when I was a kid growing up, people talk about the coming shift of the Earth's magnetic poles and how that would have an effect that would range from nothing to the complete end of everything as we know and like resetting history. Who knows, right? But there's always this idea that there's something big that's going to come, that's going to change everything. And it's exciting. It's also, I can write about it and talk about it if I am one of these deceptive newsletter writers. And there's never a day of reckoning. I can write about it for generations, and nobody's ever going to say, well, you've been predicting the end of the world. It's never happened. I'll say that, but nobody listens, right? Because people just keep reading. However, the flip side, the reality is, in my experience, and my experience involved in markets, and also looking back through history, is that things do change, but they change through a process of evolution and growth. Markets grow, markets progress. Could something happen tomorrow that completely changes the landscape in a way that nobody could imagine? Yes, of course. Anything could happen. And these are some of the risks that we assume for being in financial markets. But it kind of makes sense on one level. These really far out there risks are so extreme. Imagine a risk that would break down and change the entire financial system, and let's just say like money would go away. If something like that happens, the stops on your positions, the statistical capabilities of your trading system, whether or not you have gold buried in the backyard, these are silly concerns. So it just, it simply doesn't apply. So I think it makes sense to, and what I decided, at least, personally makes sense, is to work within a framework assuming some degree of stability. But there's also a balance, because when we look at some of these extreme events in markets, it is possible to have something that moves markets rather quickly, 15 to 20%. If you imagine that in stocks. And it's possible to have an event that over a period of many months moves markets 50%, even several 100% to the upside. So it's also not a viable option just to bury your head in the sand and say, all this is nothing, it will change. The real question is, I casually said a moment ago that these events can be transitory, they can be long lasting. Well, that is the question. And how can we tell? What kind of expectations can we have from these events? So what I want to do here for the next few minutes is to think about practically how to trade those, and how to trade these large shocks, these events, these acts of God, if you will. And I hope to generalize it so it applies to you whether you're a long-term investor, in which case, let's get straight to the punchline. If you're the long-term investor, in most cases, what you need to be doing is absolutely nothing. Whether you're a long-term investor, you're an active swing trader working on some time frame, or you're an intraday trader, the way you handle these things will be different. The shocks on your time frame will be different, but the lessons and the mindset with which you approach these concepts is similar. So that's what we're going to talk about. Before we dig into that a little bit deeper, if you've listened to my recent podcast, you've read my work, I talk a lot about a market model that basically involves mean reversion and momentum. The idea that people talk about momentum investing, which is you find what's moving in one direction, and if it's going up, you buy more, looking for it to continue to go up. And the reverse, if it's selling off, you short, looking for it to continue, going down. This idea of momentum, that big moves lead to further big moves in the same direction, is offset by mean reversion, which is the idea that big moves snap back. You have a market that goes up, well, it'll come back. You have a market that sells off, don't worry about it, it will bounce back. And these two forces, the interplay of mean reversion and momentum, as active traders, as investors, as swing traders, as option traders, however you trade, this is what we want to understand. This is what we must understand. So we need to be able to ask questions like, is this going to stop? Where do we think it's going to stop? Well, what will happen after it stops? Will it snap back? Will it pause and continue in the same direction? And many of you who have some experience as traders, as I'm talking about this, you're already thinking about, I know you are. I know you're thinking about these things. I know you're thinking about Fibonacci ratios. I know you're thinking about Elliott wave. I know you're thinking about Bollinger Bands. I know you're thinking about whatever, trend lines. And these things are very, very, very unreliable guides at best. And we'll discuss why in just a moment. So I think it makes sense to generalize this idea to markets that have had price shocks. And we'll return in a moment to think about what might cause those shocks. But all we care about, you can see this on a chart. This is one thing that charts do very well because visually your mind, your eye can summarize what the average move is, and then something jumps out on the chart as being, hey, that's different. It's very easy to, and I consider that a legitimate trading skill, by the way, the ability to just look at a market and say, hey, that's different. That's something I need to pay attention to. You can do it in a little bit more quantitative measure. I use something that I labeled Sigma Spikes, but it's a tool that a lot of people use, and it's nothing more than looking at each day's move is a standard deviation of some recent window of trading activity. So you're saying the market has been this volatile, and basically you're saying the market's been this volatile, and today's move is a 1, 2, 5 time multiple of the average day's volatility, and you can set some kind of hurdle there and say this is an extreme move. Now these moves can happen for a lot of reasons, but all that we care about from a technical perspective, at least, as we classify these moves, it's just that the big move exists. That's step one. We're talking about large price shocks to the market you trade in the time frame you trade. And that's also important, by the way, because you certainly could have a market that has a price shock on one time frame that's not really a distortion on another time frame. Imagine, just for instance, you have a weekly chart that has a very large upward spike. That could be accomplished on a daily chart, or even on an hourly chart, let's say, with just a fairly consistent trend in one direction. So what might be a large shock on one time frame might be nothing on another time frame. Thinking back to the flash crash that is now beginning to fade from many people's memory, that's an example where we had large intraday price movements, and after the fact, they don't show up on the charts in many cases. Why? Because the trades were erased, but the movements happened. And this is one thing, I think it's a fascinating question. We accept charts as being reality, but the reality is that charts have a lot of messing done with them, a lot of changes after the fact. And that's one reason why there's this whole school of technical analysis that treats charts as if they were handed to us, from some deity engraved on stone, or it's not like that. The charts are adjusted. Charts change. You might see prices on charts that never actually happened. You might see prices on charts that, in stocks, for instance, you have trades that happen off of the primary exchange. Depending on your data feed, well, those trades actually happen. They may show up on your chart, or they may not. So it's possible that you have a chart that does not capture all of the trading activity. On the other hand, some of those trades are distortions. There are a few shares. There's a lot of things that can go into it. So I try very much to get people away from thinking about a chart as being some sacred thing. It's just a representation, and a very rough representation at that. But on your time frame, you're looking at a large price shock. So, and you need some way, first of all, to define what that is. I would suggest that a pretty good hurdle is you want something that happens, say, less than once a year. For instance, with stocks, we have these large price shocks every quarter. Well, it's nothing more than the stock reporting earnings it is a distortion. It might be a large move on the chart, but you couldn't have predicted up or down, but you probably could have predicted there's going to be likely to be some kind of shock at this point. And if you were monitoring options, you probably would have seen some ramp up in implied volatility. So there's a lot of ways to think about this, but you really want something that is a once in every 5-year event. And certainly things driven by natural events. The Japanese earthquake in the Fukushima reactor event was a huge shock to Japanese markets. Hurricane Katrina was a huge shock to crude oil. The 9/11 was a huge shock to U.S. stocks and to global stocks in general. And Greece recently has been a sizable shock to some currencies, but not quite living up to those other landmark events that I mentioned. So when you go to study these and think about these, you probably need to separate the everyday craziness in the case of daily stocks, once every quarter. If you're a day trader, FOMC used to be a very volatile event. Happens pretty predictably once a month, right? So there's a sort of everyday predictable volatility from the really, really extreme. You need to be able to manage and think about both, but they probably belong in slightly different categories. So we're thinking about rare moves here. Now, I would next classify these a little bit. And here's where it starts to get perhaps a little bit subjective. Now, I don't mean, so I'm going to tell you first of all to classify these with trend or counter trend. And you might say to me, well, Adam, trend is not subjective. I define trend through, let's say a Dow theory derived structure looking at higher highs and higher lows, violations of pivot points. We all know this. Or you might say I define trends through trend lines, through crossing the moving average, through some linear regression best fit line, through slope of moving averages, whatever, ADX, whatever tool you're using, may not be subjective to you. But when I say trend is subjective, I mean we can give the chart to 5 different traders, 5 different analysts, and you may get 5 different answers for trend and 5 different answers for stage of trend. So these labels that you apply, that you might have been taught to apply, that you might have developed, these are your tools, and that's great, and you should understand your tools, but there's something you're imposing on the market. So we need to be a little bit suspicious of this, but let's classify these both as with trend and counter trend, because there's a little bit of difference with the way these tend to resolve. And if we're going to categorize with trend and counter trend, we also could consider the type of market they come out of. So do we have is it a different situation if you have a market that is strongly uptrending and then boom, has a sharp sell-off, compared to a market that is downtrending and also has a sharp sell-off? And then the third condition, a market that's kind of range-bound that has the same sharp sell-off. Might that same bar, if you just glued it to the end of those different environments, have slightly different implications and expectations? And I would argue yes, and that's what we're looking at, what we'll talk about here. The other thing, and this gets really, really thorny, is was the spike driven by news or not driven by news? Now, why is this so difficult? Because there is always an explanation. It is always possible to, and at the end of any trading day, you can go to the Google machine, and it's very, very easy to find scores of articles written both by professional journalists, professional commentators, and by bloggers, other social media types that will explain to you why whatever happened today happened. The driving forces, connecting the dots, and then, of course, it's very seductive to think that, I should have been able to see that in advance. But there's another layer here. Sometimes that's true. Sometimes there are, a crop report comes out, it was better than expected, grains have a reaction. Okay. On the other hand, there are these moves that aren't really driven by actual news. And there will be some explanation. You have to read between the lines. This is actually one of the valuable reasons that I think people should read news, is to be able to parse the news and understand what's going on behind the scenes. And there are plenty of examples of things that have large movements that are not actually justified by the news explanations, or the explanations were just somebody looking at facts and connecting the dots. Can you do this reliably and figure it out? No, I don't think so. People talk sometimes about good news, bad action, or the reverse, and I'm not sure that ever happens. An example might be a stock reports good earnings and sells off. Well, the news was good, but the stock sold off. Well, in reality, the news wasn't actually good in that case, right? The stock missed the whisper number, or there were some comments that the news was not actually good. So if you could identify those genuine cases of where the market moves contrary to the news and information content, maybe there's an edge there, but I don't know. It's not something I've been particularly successful in doing, nor particularly interested in doing, because I don't think you need to do it to find an edge. I would suggest, though, particularly with trend and counter trend, there is a difference in expectation. We'll talk about that in a moment. And probably also with the news reports, with the news-driven or not news-driven, also maybe some differing expectations there. So let's think about guidelines for managing these events. And managing occurs both, when I say managing, I mean managing positions that you have on, whether good or bad. Also could be actually setting up trades and looking for opportunity around these events. This is the same concept. So first thing you need to realize, the very first thing, is that when we're talking about these extreme, rare, historic events, we're off the map. If you think about Renaissance cartographers who would draw the maps of the world, and when they got to the edge of the known world, what would they write? Here be dragons. Well, with these moves, we're there with financial markets. Here indeed be dragons. And all of our experience and intuition is on shakier ground here because we don't know. These are spots of tremendous uncertainty and rarity and emotional extremes in markets. And by the way, therein lies a key, emotional extremes. But we are off the edge of the map. There are no magic lines or guides that apply, and I feel fairly confident saying that. Any analytical work, anytime you make a pronouncement like that, you risk looking really, really stupid. But there is this whole body of technical analysis, Gann lines. There's all these magic lines that work very well after the fact. Anybody's going to be able to show you in any extreme market move. I could produce a very nice book that would show how different magical lines work after the fact just by picking which ones I show you. I can find perfect examples for any market move. And with a little bit of manipulation of different time frames, I can find all kinds of confluences. But you can't guide your actions in real time like this. They're just random pretty charts. I personally wouldn't spend any time thinking about them. I have in the past. So if you're doing that, not to disparage what you're doing, but I've been down that road and found it to be a very empty pursuit. Also, if you have not, you can check out my blog. I've written a lot about Fibonacci ratios and moving averages and some of the things that we can test and quantify, and they just don't work as advertised. They don't work like people think they do, particularly in these extreme events. Throw all your indicators, throw all of your expectations, throw all of your guides out the window, and just realize that human emotion is driving markets. These are human emotion in fear and greed and their utmost expressions. Also in an environment where a lot of market moves are cushioned by professional traders. People can say whatever negative thing they want to about market makers or a lot of the HFT algos, but what they do is they keep markets in check. If markets go too far, well, there's somebody there to buy. And now markets have changed structurally. This may be one thing that has evolved over the past couple decades, is there are fewer dedicated market makers with chartered expectations, things they have to do. There may be some additional risks of these large spikes because liquidity, as people become afraid, liquidity will dry up. People will step back from the bid and just let a market fall because they don't really know what could happen. And you have to realize that this is a very emotional, very dangerous time. If you do want certainly as a technical trader, part of your education should involve the concept of trading in climax areas. And the idea of trading in a climax is that one-sided market moves, which are driven by emotion, very exciting, but it creates a vacuum on the other side. And I talked about this very recently in a podcast, I think maybe even the last podcast, that if you imagine that what drives markets is people moving camps from bullish to bearish, or from neutral to bearish, or from bullish to neutral. In those cases, people becoming less bullish and then voting with their money, that's what will make a market go down. What does not make a market go down is everybody bearish. When everybody is bearish, which, by the way, happens after a market's been going in one direction for some time, then the risks become where there's no place for people to get more bearish. It's like, once, if you're a trader, once you're very bearish and you're leveraged, fully committed in one direction, you can't get more. What happens then is you are very leveraged, you are very exposed, so the risk factors swing to the other side. It doesn't take much more than a small jiggle in the market, and you're nervous, and you become a little bit less bearish. What do? You buy. What does that do? Makes the market go up. What does that do? Makes somebody else a little bit less bearish. What do they do? Figure it out, right? So there is, in these one-sided market moves, there's a vacuum on the other side. And one of the most amateur, and amateur is not a bad term. It means somebody who loves something, but one of the most amateurish moves a trader can do, and I know this because I certainly did it when I started trading, is to look at a market making a big move and just extrapolate that into infinity and say it's going up, I got to buy, it's going to continue going up. This is the road to ruin, one of the roads to ruin in trading. Rather, what you should do when you see a market that makes one of these extreme moves, you should start to become suspicious. And you should start to say, I know there's a vacuum on the other side. At some point, I don't know when, but I do know at some point the market is going to snap back into that vacuum. Another concept in trading, so markets are vulnerable after they've had extended moves. Another concept that applies from trading in normal climax type areas is, what is the expectation? Here's a quiz. What is the expectation? A market makes a sharp move in one direction and then makes a sharp move back in the other direction, a significant move. Maybe it doesn't fully retrace, but it certainly goes through 50% of that previous move, and it's very, very sharp. The counter move is just as sharp, if not sharper, than the original move. What's the expectation after a move like that? Think about that for a moment. A lot of people, and if you see this on a chart, it would be a sharp V, whether up or down. But a lot of people will be thinking about some kind of opportunity to set up a trade there. But really the expectation is, after a sharp move in one direction, sharp move in the other direction, after two back-to-back sharp moves in opposite directions, the expectation is for the market to consolidate and kind of bounce around and not really go anywhere. So you put those two together, those two ideas, that a one-sided market is vulnerable, there's a vacuum on the other side, and what is likely going to happen after a one-sided move is a snap back in the other direction. And you start to build a roadmap for how markets might move in these extreme areas. And that roadmap is very, very fuzzy, very unreliable, and that's the first thing you need to realize about it. There are no reliable guides here. There's no place where you can reliably step in and say, I'm going to put on my full position. I know this is the end. Maybe we'll get 1,000 people doing that, and then the guy who does that, it turns out to be right. He can write a book, and we'll say he's a genius. I mean, he's lucky, right? However, your actual map is very fuzzy, very subject to being wrong. This map does, however, point out that markets making extreme moves in one direction are vulnerable to a snapback. After that snapback, what we typically will see is some type of settling in around a new price level. That snapback will usually be violent, and so let's put this into direction. So market's going up, 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 snaps back very, very sharp. Now that sell-off is going to scare a lot of people. There may be a couple legs down. It may sell off. It may bounce a little bit to get people back in and then sell off again. But at some point, the dust is going to settle and the market's going to become very dull and dead around one of those downswings. Flip it upside down for a declining market, selling off, rallies. Well, it's probably not going to make a full recovery. It's also probably not going to make new lows. Look at what's happened. Again, it's beginning of July 2015. Look at what's happened at crude oil for the past few months if you want a model of this. Market typically will go sideways and then eventually will stage another move. But this model should guide your thinking and acting around these extreme events. Couple more things to think about. So is the answer different if you do or do not have a position? A lot of people will tell you from a game theory standpoint that the right thing to do if you would have a position on now is to put it on. I don't think that's right. In fact, I can show you with math why I don't think that's right. I also think in this case, if you can imagine a situation where you have on a trade and you come in, the market has made an extreme move beyond your stop point. You got to be very careful with what I say here. But this might be one of the few situations in which you add to that position. You're going to have to manage it, and you have to realize that you're probably going to be in dire financial danger because you're going to be past your risk measures. You're probably also going to be at risk of losing discipline. You're probably also going to be one of the most emotional states you have been as a trader in your entire career around these events. Regardless, this may be a case in these very, very rare 5 and 10 year events when it may make sense to judiciously add to your positions. You may be able to cushion some of the loss because of that coming snapback. Now, it's also possible you may make the situation worse, and you have to realize that, and you have to figure out, where am I just going to dump the whole thing? There's definitely a point where you just have to take your loss and walk away and realize this is part of the risk of trading. In reality, trading is, you'll see lots of 1R losses, which means you lost what you were risking on the trade. Lots of 0.5, lots of small losses. And then you have the occasional 5 and 6R loss. It will happen with virtually any kind of trading, and you just have to plan for it. And I shouldn't say virtually any, because certainly some styles of trading will have this happen less, but it's not the end of the world if you are managing your positions appropriately. It can be the end of the month. It can be the end of the quarter. It can even wipe out a year's profit. But if you're managing your position size, it's probably not going to take you out of the game. That's what really, really matters. It's also possible, it's worth mentioning, that you may have a position on and it moves in the intended direction. When you think about these moves, everybody thinks about these black swans. I haven't really used that word yet. Everybody thinks about these black swan events as being always negative. Not true. There certainly will be times that you come in and you receive a gift from the market. And my advice to you, it's going to be very difficult to do. My advice to you is, when the ducks quack, feed them. When you have this gift from the market, just ring the register on at least a significant part of the position. Think, how much do you want to take off here, and take off more. If your inclination's to take off 25% of the position, take off half. If you want to take off 10%, take off more than half. Because you're going to be in this emotional state, extrapolating the move, but you're going to be vulnerable to a snapback. If you do want to trade, this is important and perhaps a little bit controversial, but if you want to trade around these positions, let's say you want to fade a Katrina type spike in crude oil. Let's say you want to look to buy Japanese stocks into that earthquake driven decline, or into the next event somewhere around the world that looks like that. So I am a big advocate of sizing your positions consistently in terms of risk. And a lot of people will look for these extreme events and try to make a killing. I don't want to make a killing. I don't want to get killed. So what you do, just to put it in very simple terms, is you trade small enough that ideally, here's what you're seeking to do. So the market has just become 10 times more volatile than normal. I'm going to trade 10 times smaller. So my risk is now what? I'm not risking 10 times what I normally do on a trade. Maybe my stop is 10 times farther away, but I'm trading 10 times smaller, so I'm risking, you got it, what I usually risk. If my trade is right, I'm not going to make my whole year on this one trade. I'm going to make a normal size trade. And that to me is this idea, if you do have on a position, you don't have this luxury, and that certainly will happen. If you don't have on a position and you want to put a position on, then sizing your position for the new volatility, and some of these positions will look ridiculously small. If you're, let's just make up numbers. If you're a stock trader who trades 10,000 shares of a stock, can you imagine what it would feel like to put on 500 or even 2,000? You're going to say this position is so small it doesn't matter. Well, theoretically the market is so volatile that that position carries the same risk. Now there's also the number two tendency. The market will go flat at some point, and now we're into the realm of trade management. But I really think this idea is of stepping back the risk, of normalizing the risk by reducing the position size. This is one of the benefits of having a disciplined, tactical, technical methodology of understanding risk and sizing for risk. It really allows us to drive toward consistency. Even when the market is not consistent, it's a way for you to push your returns toward consistency even when the market is not at all consistent. And I guess the last thing I would say here, and I've said that many, many times, but probably the most important thing to realize is that hindsight is always 20/20. Anybody is going to be able to look back on an event like this and tell you what you should have done. But it's much harder in real time, and your job in real time is to do the best you can and just not get run over. So you focus on the risk and do the best you can. That's really the bottom line. So just a quick review here. We were talking today about trading acts of God, trading volatile market events, managing risk. Talked a little bit about, actually, I'm glad I'm doing this review. It's good for me. Back to our classification. In general, and you will find this a very broad guide, which again is wrong many times. If you have an established trend and you have a shock that is counter trend, that will tend more often than not to be absorbed by the trend. So your expectation is if you have a trending market that receives a tremendous downward shock, that give the trend the benefit of the doubt. There is a good chance that that trend will be absorbed. I would point to Hong Kong stocks right now, some Asian stock markets, as examples of this. There are, of course, cases where the shocks are so big they threaten trend integrity. Mainland China, which raises the question, could we have somewhat of a disengagement there? Yeah, it's possible. A little difficult to understand, but it might happen. With trend shocks tend to be absorbed. Counter trend shocks tend to be absorbed. With trend shocks tend to be perhaps the end of the trend. You need to be very careful of those. So if you've had a trendy market, and then a large shock in the direction of the trend, that can push the higher time frame trend, your trading time frame trend, into climax, at which point it can create a vacuum that threatens trend integrity. That's a little bit counterintuitive. People would tend to think that the counter trend shocks are more dangerous, but I think at least psychologically, the with trend shocks, one of the old samurai maxims, after victory, tighten your helmet straps. And having a with trend shock in a market in which you have a with trend position is a great victory, and it's tempting to get very emotional. You cannot allow yourself to do that. And the other thing is that the moves that have clear news explanations tend to, my experience has been, I have not really been able to quantify this, but I think those are absorbed a little bit more easily. The ones that do not have clear news explanations, those are the ones you probably need to watch out for. Perhaps they point to deeper fundamentals, deeper things that are not yet apparent. So maybe there's new information coming down the pike for the market there. So maybe that's the way that's worked out. But I will tend to be much more careful with a large spike that has no clear news explanation than with one that does. And, the explanation for the one that does is just a little bit more likely reversal. And, just again, to kind of summarize here for the second time, the way you can manage these best if you're looking to trade is by reducing your position size to correspond to the new volatility so that your risk is not greater, even though that market is much more volatile. So I hope that was interesting. I hope that was useful.
It's funny how things change, and the more things change, the more things are the same. That's why we really do try to build our trading around principles, around fundamental concepts that are there no matter what changes on the outside. So as I said, you can find more of my work on my blog at adamhgrimes.com. You also should follow me on Twitter. I'm at adamhgrimes there. And while you're at it, why don't you go check out my work at MarketLife.com. If you use the code SPRING19, you get a 20% lifetime discount on all subscriptions. All subscriptions start with a trial. And I'm really very proud of what we've accomplished there and what we're doing there. We've made a difference for a lot of traders, and we'd love to have you check it out and join our family there. That's marketlife.com. We'll see you back for another podcast very soon.